I'm Imogen Smith.
I'm David Bank.
I'm Brian Walsh, and this is Returns on Investment, a show about impact investing. On today's show, private capital for public good. In response to the coronavirus crisis, there's been an outpouring of public capital for public good. Trillions of dollars in stimulus, bailouts, liquidity, and easing represents public capital for private goods, the rescue of paychecks, companies, and markets. Investors, including some senators, are playing the markets and pocketing the profits. That's private capital for private good. Impact investing has always been about private capital for public good. So how is it stacking up in the crisis? David, at Impact Alpha, you laid down what you call the 10x challenge. What is that?
Well, Brian, 10x seems to be like the least we could do, really. Like, we've been talking about the scale of the response needed to the coronavirus. And we've seen, the federal government, for example, throw, all restraint out the window, and the Federal Reserve as well, and scale up, relief packages, that are in the $5, $6, $7 trillion range, far above what was considered a bailout package back, in the Great Financial Crisis or something. And lots of money is being thrown at the coronavirus, which is appropriate to the scale of the challenge. And so the question is private capital, which is a very large amount of the capital, is it coming through in the same way? What is the responsibility of private capital to the great pandemic and coming depression? That was the question that Impact Alpha has been trying to wrestle with. And we've been scrambling kind of frankly for morsels. So, there are fund managers that are trying to rescue their portfolios by, finding, some kind of liquidity options for them. There are obviously heroic community development financial institutions we've been tracking that are, getting loans out quickly to, disadvantaged communities and underserved communities and whatnot to make sure that those businesses don't go bust, to the extent possible. There's all kinds of like impact tech types that are pivoting their portfolios to find, not just vaccines, but therapeutics or hand sanitizer or what have you, and testing and that sort of thing. And then there's even these social bonds like have been floated recently, in the sort of $1 billion range to kind of get in the public debt markets, the bond markets, get private investors to be able to backstop the need for quick capital. So there is stuff happening, but it's not like the same kind of step change of billions to trillions. So that would be like several orders of magnitude. 10x is one order of magnitude. So I figured like impact investing, writ large, should at least get to that first order of magnitude so that it can show that it really can go exponential, as needed. And that was the 10x challenge. Like, let's do that first order of magnitude.
And Imogen, you've always been our lovable but friendly curmudgeon who is always a bit skeptical about impact investing. And I think that there's an idea out there that for many years that impact investing has been sitting at the kids' table. And that the adults table is where the grown-ups do real finance, real capital markets, real transactions, and impact investing is this, smaller kind of chump change at the kids' table. What do you see as this moment right now for impact investing? Is it a chance to demonstrate that it has a role to play and that it should be at the grown-ups table?
I think that there are different strands of impact investing. The mainstream impact investing that we talk about, the sort of the stuff that's supported by like the Ford Foundation and the GIN and a lot of efforts like that. Frankly, like I don't think the grown-ups table cares what the kids are doing right now. And, I think that the problem in part is that kind of to what David was saying, like, the scale of the problem is so large and the amount of money that we're talking about is so large. And, a lot of the deals that impact investing is talking about are still so small that it's not resonating any longer. And I think, a lot of those conversations about, is KKR launching an impact fund? Woohoo! Is, nobody cares, right? So I don't think that the grown-ups table is sitting there being like, oh, where are all those impact investors at the party, right? I think that, they're talking about, risk in their portfolio. They're talking about, holy shit, what's going on in oil prices. They're talking about the repo market. They're not talking about like, oh, what is some loan doing in inner city Chicago, right? It doesn't mean that like that work isn't important and that it isn't providing a vital service to individuals and communities, but it's not really, it's not relevant to the larger conversation. Now, the important distinction is when you're talking about DFIs, right? When you're talking about large financial institutions that this is what they do, that is very much relevant. And in some cases is going to be sort of like the only game in town for financing businesses in particularly emerging market countries. The problem in part is that historically there hasn't been any, that is not, the institutional investing community has no idea what those people do for the most part, right? It's not, they don't spend there isn't a lot of interconnectivity between those conversations.
Can I jump in to say that one of the marks of when you're still at the kiddie table is when you still need the approval of the adults to move away from the kiddie table? And I don't think impact investing needs to be, admitted to anything.
Doesn't need to ask for permission.
Doesn't need to ask for permission from anybody or admitted to anything. I think what we're talking about here is that as the recovery unfolds, I don't know, I guess recovery assumes you've hit the bottom. As the crisis unfolds and the recovery eventually ensues, the channels of getting capital out need to be, like I said, 10x, 100x, 1,000x bigger than they are now, because every community will need it, every business will need it, every restaurant, every dry cleaner, every main street, every supply chain, every food basket, food area will need to be refinanced, basically. And the banking opportunities, the investment opportunities, but then also the social design opportunities of how you're going to reinvest all that are going to be immense. And those are the very things that presumably impact investors have been incubating all these years. All of those ways of getting capital out, all of those ways of thinking about long-term impacts, of thinking about ecosystems, all of those kind of things. I'm saying if they don't take advantage of this opportunity now, it ain't coming back again. The money's going to be gone. The communities will be, in dire straits, to say the least, and everybody will say you had your shot. So I think it's almost a do or die moment for folks who think that they have a better plan, because the old plan basically didn't work very well. So the world is open to solutions now. The money is flowing. It's not like there's a shortage of money now. There is more stimulus money out there than has ever been, imagined. So this is the time to act. That's my, and the kinds of things you're saying, Imogen, are all exactly true, and sort of the problem at some level, which is everybody thinks it's just going to be reflating the same old, and that's basically because that's what they want it to be, and that's not what it should be. And that maybe I'm too long sitting in quarantine here in my own house thinking of these things, but it's driving me nuts. You don't get a disruption like this very often. Let's take advantage of it and build something new.
So I wonder if, I think one of the problems impact investing has, and that has always had, and we've talked about this in the past, is its own insularity, right? Like it is, in many respects, very inward looking, and likes to sort of do things on its own and go its own way.
Follow the money, I always say. Its own way is the way where the money flows. And we've seen the the sort of ESG whatever modest performance bonus or something. That's probably good, but that's kind of like beside the point in the scheme of things. I think what the scheme of things is more like what these universal owners that we wrote about a while back, and our friend Hiro Mizuno from X of the GPIF and Chris Ailman from CalSTRS, and all those folks are, even before the virus, before the crisis, we're saying we need to have a new way of thinking about the sustainability of the financial system. And so it's not just going their own way when folks like that are talking about moving, hundreds of billions of dollars.
But yeah, okay, so strongly disagree with you. I think that one of the things that's going on in the institutional investor space is you're seeing all these people come out with like white papers and saying, oh, we should do blah, blah, blah. And meanwhile, they're not doing cool, right? And so they're still perpetuating the same system. They're still investing in private equity. They're still undermining sort of the very things that they claim to believe in. And so,
But didn't the crisis quote unquote disrupt some of that thinking, or shouldn't it?
No, we've increased. I mean, the 2008 crisis or the most recent crisis. The most recent crisis hasn't done anything in terms of like institutional investor thinking at this point. They're just thinking like, holy shit, like.
Well, let me ask you a question. Let me ask you a question. I agree with that. Holy shit, and how do I hedge and whatnot?
Swearing in this.
Yeah, just so you know, the swearing wouldn't be taking place at the kids' table.
I don't know what kids you've been hanging around with. In my teenager, it certainly would be.
Certainly would if I was there.
But Imogen, to your point, would they think that, systemic risk has taken on a different meaning for us than it did beforehand? And when folks talk about the systemic risk, just for example, of climate change, that now has increased salience. Is that discussion going on at all?
Yeah, they're just going to, I mean, it's fascinating to me that, a global pandemic was not being viewed as a serious systemic risk before this. The fact that Bridgewater was like short vol going into this is mind-blowing to me, right? Like, I don't understand. If your job is to be a risk
Explain
manager,
that to our listeners, as I always say when I don't understand something.
So Bridgewater, there was this whole thing with like risk parity, which is an investment strategy blowing up going into this crisis. And basically, they had not factored in the impact that the coronavirus might have on their investment strategies. So Bridgewater, which is, the largest hedge fund, very highly regarded fund, run by a guy called Ray Dalio, lost a shit ton, to give you the technical term, of money going into this crisis. And the reason is that they did not think that they didn't think there's going to be a huge downturn. They didn't think there's going to be a huge amount of market volatility. They basically, according to them, they were tracking the coronavirus, but they didn't think it was going to be a problem. And I don't understand. And, this is sort of like, a classic black swan thing. And the problem with the way that risk management works and financial analysis works is it's backwards looking. So because, very simplistically, because every other global health crisis or potentially global health crisis in recent memory has not had a financial impact, or serious financial impact. So SARS did not have a serious global financial impact. It certainly didn't have an impact on the US. Swine flu didn't. The AIDS crisis didn't, right? And so it was not being looked at as a potential devastating risk. And as a result, you had all these fund managers who were just like, hey, everything's fine. And actually, where in Bridgewater's case, even short volatility, the volatility index being sort of a sign of, the amount of risk or volatility in the markets.
So they bet against volatility and lost.
Yeah, but the fact that you would actually it wasn't even like they were neutral. They literally, and then Ray Dalio was like, hey, it was kind of like, the Bernie Sanders or the Jeremy Corbyn, we had all the right policy. Everyone agreed with our policies. They just didn't vote for us. He was like, our risk systems worked. We just lost money. And so, what will now happen is, yes, they'll be like, oh, we should consider this to be a risk. But that doesn't mean, and again, like CalPERS took off, and, Institutional Investor actually did a very good job on this. CalPERS took off, they had a hedge strategy on post 2008, and they took it off, I can't remember exactly when, but within the last 12 months, because they didn't like paying for it. And then, the world blew up, and one of their board members was like, oh, how's that risk strategy working out?
Well, that's why I pay my earthquake insurance every year out here in California, because I assume the year I don't pay it, that's when the earthquake will hit.
So we'll know if there is an earthquake that you have you paying it. But yeah, so are they going to look at global risk differently? Yes. Are they going to, address the fundamental underlying problems? No, right? And that's,
that's okay.
issue.
So risk was only one of my four arguments.
Okay.
You want to hear the other three?
Sure.
Risk you've blown out of the water. The other three is that the social, people have been saying this, that, it's sort of the moment for the S in ESG to rise, and it's social's moment, because now all the social needs are so clear and apparent, and everybody will pay attention to them. And Morgan Stanley actually took this as a signal that costs, labor costs would go up because basically workers would be demanding more benefits and wages. And of course, that's a drag on earnings at some level. So there was sort of a watch out for the earnings of anybody that might have to pay their workers more. But from the other point of view, it was get ahead of that and pay your workers and treat them well and build a good company with good benefits in the new world could be valued well, right? Because actually that's what the world kind of needs. So that as this new social contract, and that could be institutionalized because that maybe they won't do it on their own, but it could be institutionalized, for example, by a new administration, just for take one example in the United States, and in a kind of way that rewards companies that help rebuild from the crisis by employing folks. So that was another idea: forge a new social contract.
So and then you want me to tell you why you're wrong on that one when it comes to
that one? I can almost write your script for myself. The third one was
well, wait. Now let's just take that though. Why Imogen? Why is he wrong? Why are companies not going to build a new social contract in light of the coronavirus crisis, where they will recognize that their human capital should be an asset to their business and that they should invest in worker protection, paid sick leave, better wages, things like that to invest in this asset? Why will that not become the American model social contract?
The American model of capitalism believes that the business of corporations is to make money for their shareholders. And
I thought we got rid of shareholder primacy, and we're into stakeholder capitalism.
Yeah, that's what you think, but you're wrong. And the problem is the majority of asset owners and investors still believe in shareholder primacy and have been benefiting from that. And so if you want, and this goes back to the question of sort of why isn't impact investing at the big kids table? And part of it is because we need to have a conversation about organized labor, and you need to bring unions into the conversations, and unions need to come into the conversations in ways that are valuable and meaningful. And until they step up as stakeholders and they say, I don't want my pension money going towards things that are undermining labor, then you're not really going to see meaningful change. And the reason that that's not happening is because of pension obligations and this belief that the fiduciary duty means I have to go and invest in the highest performing assets, even if those highest performing assets undermine and undervalue labor. So, and I think, again, this is one of the ways in which maybe the impact investing movement in some regards has been focusing on the wrong questions. Maybe it's not so much about maximizing, the capital, but as it is sort of maximizing the transparency and the monitoring of that capital and ensuring that we put in place sort of the correct rules of the road to see, to have these changes happen.
Correct rules of the road, I couldn't agree with more. Like, for example, even a Republican, may not have this right, so it bears some checking, but Josh Hawley from Missouri, young up-and-coming Republican, is calling for the government, in effect, paying like 80% of the wages of the workers. So the rules of the road, I think, are up for grabs. So I agree with you that it's going to require some mandates in this case, at least some tax policy of some sort.
So yeah, I think
I have another one.
I know. I think I know what your next one is, but go ahead.
Hold corporations accountable. That, in effect, goes back to the stakeholder thing, which and you're completely right again in terms of the emptiness at some level of that business roundtable pledge last year. However, as a journalist, we've been making great hay with it because you have it in writing and signed by 181 CEOs, and they say things like, we're going to do well by our workers, we're going to do well by communities, we're going to do well by our suppliers, for example. And you have, just as we're going into right now, the annual meeting season and shareholder resolutions and whatnot, and you're going to have asset managers. Hopefully asset owners, as I've mentioned, universal owners and others, asset owners holding asset managers accountable to holding corporations accountable. So it's a new day for shareholder democracy and corporations now being stakeholder entities. you can mobilize all that corporate power for public good as well. What do you think, Imogen?
So,
well, wait, just on that piece, though, David, let me jump in. That is in a compelling case has been made about the Business Roundtable statement on this idea of stakeholder capitalism. That in fact, it's a part of a broader battle, if you will, between management and shareholders and boards, and that you're effectively it's a power grab by CEOs to say, well, we're going to determine what's in the best interest of these different stakeholders, and so give us that leeway to make those trade-offs and make those decisions. And it's actually against shareholders.
I agree, Brian. We made, I mean, that was the criticism of it. But the question now, and it's the same question I had to Imogen before, is doesn't the crisis change that? Haven't stakeholders, for example, just become that much more, essential to any enterprise? And to the extent that we don't at least make the case that it has changed it, I think then we will slip back into sort of status quo, all too quickly.
So I have mixed views on shareholder engagement. I used to be fairly negative on it because, I think we've been sitting around having these nice chats for 40 years and it's hard to see that really much has come out of it, right? And, when you look at proxy and even stuff like, frankly, all the efforts around, the climate change, carbon disclosure, 2-degree scenario analysis, in a very real way, it's not really moving the needle in terms of what these companies are doing. Enron's still turning around, so Exxon is still turning around and telling shareholders to get lost. And if PERS and STIRS aren't going to divest from fossil fuels, then they can sit around and have these chats as long as they want. They're not necessarily achieving very much, and it becomes the thing you do absent real action.
That's why some people are saying if there is going to be an oil bailout, just make sure that the public gets 51% of the shares so that we can have, vote new boards in and manage the decline of the oil companies. I mean, that would be real shareholder engagement.
Yes, but that's not going to happen.
So I've only got one.
No.
You've knocked 3 of the 4 legs out of my table here. It is wobbling badly.
Hold on. I do think, but I think that, I think shareholder engagement can, in instances, be effective. And I've seen, I think long-term dialogues with corporations can matter. And I have seen it be effective. But again, I think that it needs to be meaningful, and it needs to have a holistic approach by what do we mean by stakeholders, right? So yeah, it needs to really, and then it can't all happen behind closed doors, right? There needs to be transparency and accountability to encourage and force meaningful change. So I agree with you that there is, and it's not just, it's not just shareholders, it's consumers, right? I think that sort of galvanized action to force companies and management and leadership to change can make a difference.
Okay, once again, I'm in complete agreement with that and in favor of exactly that kind of pressure. Can I give you my 4th just so you can demolish it and I'll go crawl under a rock?
Sure.
The 4th is that it's about expectations. It's about a bet on the future. And that at some level it wraps the other ones together, but it has to do with where you think the world is going. And so investors, as you know way better than me, will make bets on all kinds of things, like you just mentioned, on volatility in general, on the discount rate and when the Fed will act, on what the trade deficit might or might not be, or whatever, the new jobs numbers, and they'll make bets. And what if investors made a bet that we, in fact, were going to muddle our way through and get to the other side, not only of the pandemic, but of the climate crisis and the sort of sustainability and environmental crisis in general, and sort of a social dislocation that has roiled through the world in a big way. And that in fact, there was another side of that, and that was something like the sustainable, inclusive future that we all kind of dream about in our fevered imaginations. And that, in fact, they wanted to be part of that future because that was going to be better for business as well as for all their, quote, stakeholders. And so instead of just hedging, as you said, instead of just taking out a little bit of a low carbon fund here, a little bit of an SGG bond there, making sure that they, were properly balanced in their portfolio against all that they actually bet on saying, we would like to be invested in that future that is better, not only better for all of us, but better for business. And that's where we want to go. Kind of the universal owner argument that I was making earlier. But everybody, instead of just those big guys, everybody basically said that. We're going all in. And that if God forbid, our political leaders said, we're all going all in, and everything is pointed in that direction. And that's where the future is. That's where you want to be. That's where the smart money is going. So that's my last claim.
Yes.
It's basically leadership yes. Bets on the future. Could that work?
Yes, it's not going to. Well, yes and no. I was with you sort of 50% of the way through.
Oh, just give me a yes, please.
No.
Imogen, throw him a bone.
So I think that, on the one hand, in effect, what you're kind of saying is the sort of the generation investment management argument, right? Like, the smart way to make money is make long-term bets on smart, progressive companies that are leading the way into the future, right?
Indeed.
And that, yes, that makes a lot of sense. And I think that is sort of the sustainability argument. And you do see investors doing that. The problem is a couple of things. One, a large problem is indexing, right? That because I'm a universal owner, I just own everything. I'm just making a bet on the economy. I'm not leaning into, one company or another. I'm betting on the whole thing. And so in a sense, my view becomes irrelevant. And, it will be interesting.
Change the indexes, change the markets, we've always said.
Yeah, but, you're asking for a complete systemic shift to change the indices. Institutional investors and Wall Street alone, left to their own devices, won't do that. And they would say, that's the purpose of the market. The market will figure that out, right?
But the index is a particular slice of the market, a particular algorithm. You could have a carbon weighted index. You could have a sustainability weighted index, and you could rebalance it every day, and people would make a ton of money rebalancing it, and it would just drive towards the goals you want.
An index is not meant to be David Banks' view of what the future should be. An index is meant to be the current reflection of where the economy is, right? So,
well, where the market is.
Yeah.
Indexes are generally market cap weighted so that you have the same weighting as the rest of the market. But that means you're buying high and selling low.
Sure, but this nonetheless,
and it also means that you're just chasing each other's tails, and so there's nothing magic about market cap weighted indexes. You could weight them by whatever.
And yet, nonetheless, what we've seen is institutional investors over the past decade going into indexes at a higher and higher rate, including your friends, the universal owners. And they're not all going to suddenly turn around and be like, you know what, I'm going to invest in the, low carbon indices, because that's not how investors work. And their job is not to be forward looking. Their job is to be conservative. So that, the way you would have to force that change through regulation.
Exactly. Well, again, doesn't the disruption and the crisis cause a fundamental rethink of the assumptions the assumptions that you both have all laid out, which are exactly, I'm not disputing that is the current state of play. What I'm just positing is, doesn't a disruption of this scale actually open the way to question those underlying assumptions, change those underlying assumptions, design a system more resilient, more sustainable, more inclusive.
But David, to play devil's advocate, the cause of this crisis was external to the market, right? It was this global pandemic, it's different from the Great Recession that was caused by a housing crisis, and you can debate the different roles the different actors in the market played. But there was a clear case to be made that change was necessary after the Great Recession and the global financial crisis caused by the housing crisis and collapse and lots of different kind of activity that you could say there are some bad actors involved. With this, it's not as if the markets themselves, maybe they didn't price in the risk of a global pandemic well enough, but it's not the cause of this huge financial challenge we have right now is not due to the nefarious actions of actors in the market. It's
Well,
due to
yeah, no, I
right.
think
So
that's a good distinction to make. But I have two quick thoughts. One is, you could make the argument, and people have, of course, that it's not really as much of a black swan as all that, since everybody was predicting it. And as Imogen said, it was sort of, I think in all the contingency scenario planning of all these major institutions, central banks and whatnot, pandemics did merit, at least a footnote and some list of possible risks. But so it wasn't exactly a black swan. But leaving that aside, even the broader point seems to me is that take a gift when you get it, right? Like if the green movement said we have to shut down the global economy in order to shift off of fossil fuels and change from an oil economy because the climate crisis is so severe that we must shut down the global economy, you think that would fly in any political environment that we've ever existed in? No. So it couldn't be done as a green thing, and we wouldn't want the entire world blaming the green movement for shutting down the economy. But lo and behold, something happened that did do exactly that. So now you don't have to be blamed for it, but it happened and the global economy got shut down. So take that moment and put into place the plans that you had for the other side and go and run like hell while the window is open for that brief second before it slams shut again from old thinking. I know I sound like a crazy person who's been locked in my house for 7 weeks.
there's a reason for that. So Imogen, where do we go from here? I don't mean in our podcast conversation. I mean, where do you see the opportunity for us to move towards a more inclusive, more sustainable financial system in the future?
I think that we have to take a more holistic approach. I think that it's not, change is not going to come out of the the investment offices of really anywhere. Change is going to come through stakeholders, voters, organized labor, consumers, forcing the change we want to see in the world. I think the danger of this moment is that the corporations just keep getting, Jeff Bezos gets even richer, and you have a bunch of workers on the front lines who are. I do think that we are recognizing the importance that essential workers do, right? I think that you would have to be an incredibly heartless human being not to think, oh my god, like we are valuing the wrong people. And so I think on a personal, and this happened after 2008 in finance, actually. You saw like a lot of bankers kind of realize, holy shit, I didn't want to be spending my time ripping off people and doing terrible things, and sort of reevaluating what they do. And I think that there will be a reevaluation by many, certainly not the political right, of who is important and how we value people. And I think that, look at what's happening with the UK with the National Healthcare Service. The Tories were like trying to destroy the NHS, and then, it saved Boris Johnson's life, right? Like, if that doesn't do something to someone, and if that doesn't do something to a party, then I think that we're in real trouble. But I don't think that, I think for all of this, it's a marathon, not a sprint. And it's going to be building on those incremental changes and that visceral recognition and moving towards making a difference.
I was right with you, Imogen, and I wanted to end on a note of strong agreement, because I do think the popular mobilization that you called for is exactly right, and it is not just investors sort of waking up and thinking this. It's pressure from obviously not only asset owners, but like you said, workers, customers, and communities. Political movements, et cetera, and that. So I totally agree with that. I lost you at the incremental, building upon stage, because I think it's always kind of too early until it's too late, and I've just seen, grizzled veteran as I am, all these crises where things open up and then they slam shut very quickly. Then all of a sudden the money's all gone, the deed has been done, and you're left to again pick up the pieces, rebuilding from a worse position. So I think you're probably right in the way that that's how it turns out. I just want to cling to my faint
no, I mean, and maybe we do
threads of hope.
Maybe we do find a way to rebuild from a stronger position, right? Like maybe it is like having clarity of purpose and sincerity, and kind of finding those people and supporting and empowering those people, not the ones who are necessarily like, beating themselves on the chest and saying what a great job they're doing, right? Like it's kind of finding like new heroes and new ways of doing things, but that also means changing the status quo. And I think the danger is that the majority of people in positions of power, and by the way, that includes a lot of people in impact investing land, don't actually want to change the status quo. And that's
now
why change
you're getting
is hard.
to the heart of the matter, and I think that would be a great follow-up conversation. Brian, can you?
I agree. I agree. I think that's a good place to leave it for now, and I think that's a good conversation to pick up another time. That's going to do it for this episode of Returns on Investment. Thank you so much to David Bank.
Thank you, Brian, and thank you, as always, Imogen.
And thank you to Imogen Rose Smith.
Thank you, Brian, and thank you, as always, David.
That's great. And you can read more about private capital's response to the coronavirus crisis at impactalpha.com. Only subscribers receive full access to Impact Alpha content, including deal flow, job postings, and a Slack channel. Thanks to David Bank, Imogen Rose Smith, and our producer, Isaac Silk, who also wrote the theme song. I'm Brian Walsh, head of impact at the fintech company Liquidnet. We'll see you, in some sense of the word, next time.